What's up, guys? Today I thought we would look into this compound interest calculator. I'm on the investor.gov government website, and it looks like it has some pretty good information. Today we'll today we'll look at the compound interest calculator and get an idea of how long would it take for us to accumulate, say, $1 million by investing in something like the S&P 500, a broad index, not individual stocks, but a broad market index. Simple. Okay. So, so before we go into the compound interest calculator, let's talk about interest. There is two forms of interest. There is simple interest, which we see, for example, when you put your money in a savings account. So you put $100 in a savings account, say for example, and the bank is giving you 5% interest. You put $100 in the bank on January 1st, and at the end of the year, you'll have 5% more than you started with. So $100 put in, end of the year, you'll have $105. That $5 is simple interest. That's the interest you earned. In the next year, now you have $105. The $100, which is the principal, and the $5, which is the interest you made. But year two, you'll still get an additional $5 because they're only giving you interest on the original principal. You're not getting any interest based on the interest that you made. In other words, your interest is not going to make interest. Only your principal will make interest, if that makes sense. That's called simple interest. Now, compound interest is more powerful. That's when your interest makes interest. So continue with that same example. You put $100 in the bank. After year one, you have $105, right? Because your $100 made 5% interest. Now, at the end of year two, your $100 will make another 5% or $5, but now your $5 will make 5% as well. So that'd be about 5% of $5 would be 25 cents. Okay? So the interest, the $5 will make 5% of itself. So your interest will make interest. That's how compound interest works. With small numbers like that, it may not seem important, but when the numbers become bigger and over a long period of time, that's how you'll make money, right? Albert Einstein called compound interest the eighth wonder of the world because they can take such a sum, because they can start with something so small and end up with something so huge. Just imagine if someone had began to invest for you when you were born or when you were in the first grade, how much you would have now. So with compound interest, the main thing is consistent investment and time. Right? Even if you're only investing a small amount, given enough time, you could end up with a large sum of money. So let's do some examples and play with the numbers and kind of get our mind working. So let's look here at initial investment, right? That's the amount of money that you have available to invest initially. Let's say initially we have zero, right? So conservatively, we have zero. We have zero. So initial investment is zero. Our monthly contribution, right? That is the amount we're going to add to the principal every month. The principal is the money we're starting with. Our principal is zero. The amount we're going to add every month is going to be, let's say we're investing $100 a month. Okay, we're $100 every month. Length of time in years, another variable. let's say we want to invest, let's give it a 10 years. Let's give it 10 years. We'll invest $100 a month for 10 years. Now, interest rate, another key variable. The interest rate is the rate of return that we're expecting to receive. So the interest rate is the rate of return we're expected to receive. Also a key variable in how much you will, the rate of return we're expecting to receive. Also a key variable to determine how much money, the estimated interest rate or the rate of return is how much rate of return we're expecting annually. Key variable in how much our money will grow. So the S&P 500 over time has returned about 10% annualized. It's not 10% every year, but over time, it's averaged about 10% per year. So we'll use that. We're going to invest in S&P 500 index fund or ETF. Interest rate variance is they put range of interest rates above and below the rate set above that you desire to see result for. So let's put 5% below and 5% above. Range of interest rates. So we'll put 5, maybe we gotta put a comma, 5 and 10, or maybe 5 and 10. Range of interest rates that you desire to see results. We'll put 5, meaning 5% above and 5% below. So anywhere between 5 and 15% we'd like to see. Okay. And then compound frequency. Times per year that interest will be compounded. Interest is going to be compounded. With S&P 500, it's usually 4 times a year, every quarter. So here are the results. The graph in red is going to show us if we got 10% return. That's where we'll be, right? So our future value at 10% return is going to be about $20,000. If we only got 5% return, that's going to be the blue, light blue. We'll only end up with $15,000. That's the blue line below. If we got 15% with a higher rate of return, we'll have more money, $26,000, which obviously makes sense. Now, let's leave the contribution the same, $100 a month, and let's extend the time. Let's extend the time. So we're going to change this to 20 years. So we're still doing $100 a month. So we're still doing $100 a month. So this is important because sometimes, in the beginning, you don't have a lot of money to start with, but you want to get started. So now we extend it to 20 years, $100 a month. In 20 years, see, we're going to end up with about, in 20 years, we're going to end up with $59,000, so about $60,000 if we're getting our 10% return. If we got less and we only got 5%, we're going to have only about $34,000. And if we're getting 15%, you see we're already at $105,000. You see how the interest rate or the rate of return is very important, right? The 5% extra above the 10%, you see the curve is already beginning to curve, okay? So that's why rate of return is very important. 1% extra, 2% extra rate of return can make a difference, okay? 20 years, and you see, because of the extra 5% return, you have pretty much almost double, right? 74,000 to 144,000, almost double because of the extra rate of return. Now, let's crank up. So this is in 20 years, right? Not bad for $100 a month, right? A lot of us can do $100 a month. Make it automatic. And in 20 years, you'll have, we see $74,000. Obviously, if the rate of return is better, you can get better. But to get higher rate of return, you may have to do a mix. You're like, how can I get 15%? Well, you can have a mixture in your portfolio. You could have your portfolio, a portion in the S&P 500, getting 10%, and then you may have a portion in individual stocks who may beat the market, right? You may have a couple of, you may have a small percentage, 10%, 15, 20% of your portfolio in individual stocks, and they may be getting better return, 15, 20, 25, 30% return. So that will boost the overall, that'll boost the performance of the overall portfolio. This is what they call a satellite, core and satellite position. So your core, maybe 50% of your money in the S&P 500, and then maybe the other 50% in some individual stocks that are high growth. Okay, but again, you're doing a small amount, $100 a month, and in 20 years you end up with a nice, um, portfolio. $75,000, nothing to sneeze at, and you're only contributing $100 a month. That's great, right? Now, let's look at if we extended it, and we'll go out to make it 30 years. Okay, so you are $100 a month, and you now 30 years. Let's see where you are. In 30 years, they're talking about $220,000. So you are doing only $100 a month. You're not doing a lot. You're doing $100 a month. You're not doing a lot, right? So the 30 years, you see your future value here at 10% rate of return is $220,000. You see, as time goes out, you're beginning to see as time goes out, you're beginning to see the separation between the variance, meaning 5% or the light blue line, only at 82,000. So less than half of the 10% return. They're only at 77,000. The 10% return is at 220,000, and the 15% is already at $655,000. All of these are still all of these are only $100 a month. So the amount you're contributing is the same. The only difference is the rate of return. You see, the extra 5% rate of return or 15% rate of return in the same time frame. So the amount you're contributing is the same, $100. The time frame is the same. The only difference is the rate of return. So the investments, what they're investing in, is different. So 5% rate of return, it's not going to grow as much. A 10% rate of return is going to be here. A 15% rate of return. In 30 years, they almost tripled, right? They're more than double. They're at $655,000. That's why a rate of return is important. But obviously, that comes with some risk, and you have to know what you're doing, due diligence, and all of that. But it is not a lot of money, $100 a month. It's the time in the market. You're just consistent every month, the first of every month. Your money's going in automatic. Now let's go to 40 years. And we will see. Again, it's the S&P 500. This is nothing complicated, right? We could all invest in S&P 500 index fund or S&P 500 ETF from Vanguard, ticker symbol VOO, or from Charles Schwab. Just Google S&P 500 ETF, or from Fidelity, right? This is not complicated stuff, but the power is amazing. 40 years, right? Let's see where we are in our 40 years. In 40 years, they said you're going to end up with about $611,000, right? So this is the future value at 10% return. So you're in an S&P 500 index fund, 40 years, you'll have $451,000. I know you've been contributing is $100 a month. That's $25 a week, $100 a month, and you've been reinvesting the dividends as well. You've been reinvesting the dividends, right? They pay dividends. You're going to reinvest the dividends, buy more shares, and you're going to reinvest the dividends, and you're investing $100 a month. dollar cost averaging, what they call DCA. Whether the market is up or market is down, your money is going in. $100, $100. When the market is high, you'll get fewer shares. But when the market is low, you'll get more shares. And you just keep going. 5% return, you'll only have about $87,000. And this is why we don't put our money in savings account or CDs or lower return. Right? At 10%, you'd have over $600,000. The 15% return, you see the hockey stick is already occurring. They're already curving at a hockey stick. They're already at $2 million. The 15% return after 40 years, $2.8 million. $2.8 million. So here we see after 40 years, the 5% return is only about $151,000. The 10% return, like in S&P 500, would be at over 600. The 10% return would be over $600,000 at $100 a month. You'd have $100 a month. You're not even gonna miss that. And the 15% return would be almost $3 million. You may say, listen, brother. 40 years is a long time. 40 years is a long time. However, how old are you now? And if your parents had began an account for you, such as a custodial account, how much money would you have now? Depending on your age, how much money would you have now? And if you begin that for your children when they are, when they're born in a custodial account, right? Fidelity and Vanguard have them. How much will they have when they're 25, when they are 30, when they're 35? And then that's how you think of it. Don't think of it as this is going to take so long. Yeah. Time is going to move regardless of what you do. Time will move regardless of what you do. But you can take advantage of the time by beginning now. Now, let's begin to change some of the other variables, such as monthly contribution. Okay? Let's go back to 10 years. Okay? And from $100, let's go and see what if we can do more than $100 a month. Let's see if you can do $300 a month. You can do $300 every month, and let's see where we would be in, again, 10 years. In 10 years, you're getting $60,000. You're doing $300 a month. In 10 years, you have $60,000. You see the 5% return have $46,000, and the 15% is $80,000 already. That's not bad for $300 a month. I mean, where are you gonna get the money? You're gonna get the money. Where will you get the money? You'll get the money from tightening up your finances, cutting your expenses, paying off your credit card debt. A lot of us are paying $300 a month to our credit card or more. Get rid of the credit card debt, because that's probably the biggest killer. And just begin to be more mindful of where you're spending your money. Because when you have something that you're trying to do, you're gonna be very purpose-driven with your money. So 10 years, and we already have $60,000. Let's go and see where we would be at 20 years. In 20 years, we would have $223,000. $223,000, and we're investing $300 every month. $223,000. That's great. Now, let's look at 30 years. At 30 years, we would have $660,000, right? This is our red here, our 10% return. We'd have $660,000. The 15% return, obviously, you'd be almost the 15% return. If you were able to get that, you'd be already at to $1 million. Okay? So we are going to educate ourselves by looking at different investment. You start off with the S&P 500, but then after that you begin to start looking around and learning. Okay, let's look at 40 years. 40 years, we would be at about $1.8 million. So that's $300 a month after 40 years. And look at the 15% return. They're already at almost $9 million. Wow. You see the different, that extra 5% rate of return over time? You see that separation? That's how the rate of return affects you. Okay. Now, let's crack this up a little now and go to, let's crack this up a little. Let's go to $1,000 a month. Let's go to $1,000 a month. And we'll go to 10 years. So $1,000 a month in 10 years. You're already at $200,000 with S&P 500. You're already at $200,000. Let's go to $20 years. You're already at $745. In 20 years, at $1,000 a month, you're already at $745,000. Almost $745,000 there for $1 million already. $745,000 in 20 years. Look at that. Now, just for the fun of it, let's see where we'd be at 30. Just for the fun of it, actually, let's see what we would have to invest in the S&P 500 to make it to $1 million. We're pretty close with $1,000. Let's look at $1,100. $1,100 a month. Let's see where that would take us. $1,100 a month puts us very close. It's about 819,000. Let's go to $1,300. $1,300 a month, and the S&P 500 would take you to very close to $1 million, about 968. So 1,350 should do it. So it looks like it's gonna be about $1,350 a month in the S&P 500. In 20 years should give you $1 million. Yeah. So about $1,350 a month in the S&P 500 in about 20 years would make you a millionaire. Obviously, if you're getting 15% return, you'd be almost a $2 million. But to see, so you see, if you want to get to $1 million status in 20 years, you have to invest about $1,400 a month in the S&P 500. In the S&P 500. But we know that time is a powerful catalyst, because when you go to, I'll bring this back down to 1,000, and you go to 30 years, let's see where we are. Still doing $1,000 a month. In 30 years, we're over $2 million. Okay? We're over $2 million. We're at 10% return. Obviously, 15% return, we're at $6.5 million. Let's go to 40 years. In 40 years, $1,000 a month, we're already over $6 million. And this is here. the red. If you're getting 15% return, you see you're already at almost $30 million. So this video is one of those videos where it's good to project into the future, to look and see that what determines where you end up is what you're doing now. Gotta have the vision, you gotta have the dedication, you gotta have the discipline, okay, to do what you need to do in the month of January 2024 and do it again in February by getting your finances right. Again, guys, the MD Investor trying to increase our financial IQ by educating ourselves and educating our children so we can break the cycle of generational poverty. If you have not subscribed yet, give me a subscription on YouTube and a thumbs up. And again, and I will see you in the next one. MD Investor